Understanding your options when considering crowdfunding is very important. But before we go into that conversation, we want to talk about why crowdfunding exists at all. As you may know, most jobs in this country, the United States, are created by small businesses. Of those, over 80% of small businesses have fewer than 10 employees. And it is those small businesses that produce much of the intellectual property that we use day to day. However, when it comes to funding opportunities, those tend to be limited for those same small businesses. First, collateral is needed for most bank loans. Small businesses either are startups and don't have that collateral or have been in business for a while and still just don't have enough collateral to cover the cash flow needs that their business has. The second is revenues are required for most funding options. While this might be an option for existing businesses, new or startup businesses rarely have revenues to show in order to get the money that they need to grow and start. Even if companies are able to raise venture or angel capital, only 1% of companies ever get that type of funding. And so we're trying to assist those other 99% of businesses who won't get angel funding, who won't get VC capital, and are still denied bank loans. And then lastly, even if those businesses are able to receive that venture capital or those angel funds, the term sheets tend to be very unfavorable to the business owner. You might know or have seen a Shark Tank where the individuals who are investing in the businesses ask for 20, 30, 40, sometimes over 50% of the business in order to make that investment. And then they'll want other limitations and restrictions on how the business owner acts and what opportunities they take advantage of. This tends to be the case with most funding term sheets that are given to a business by an angel or a VC. With crowdfunding, we take that out, we reverse that trend, so it's the business owner that gets to really write the terms of the deal. And crowdfunding isn't new. While the term is new, it was just coined a little over 12 years ago. The process of crowdfunding has been in existence for decades, even since the last century. Some of you may not know this, but the Statue of Liberty was actually a crowdfunded activity. At the time that the statue was gifted by France to the United States, there was not a base to put the statue on. And so there was a call out over a local newspaper for individuals to give small donations to help build this base. Those donations were collected, the base was built, and so the Statue of Liberty stands. Beyond that, there have been some recent crowdfunding platforms that have popped up over the time. Some focused on artists, some focused on donation, some focused on businesses and helping them get the funds that they need. And in 2012, that's when the Jobs Act was passed. The Jobs Act, which stands for Jumpstart Our Business Startups, is what actually allows for equity crowdfunding to take place. This is the law that states that now private individuals who are unaccredited, those making less than $200,000 as an individual or $300,000 as a couple, and or have a net worth of $1 million or less, not including their household. Now these individuals can invest in private enterprises, where before 2012, this had been an activity that was restricted and prohibited since the Securities Act of 1933. So now let's go into the different types of crowdfunding that exist. There are four types of crowdfunding available to businesses and individuals at this time. The first is donation based crowdfunding. This is where individuals invest, or not invest, they donate to a cause with no expectation of return. So maybe someone has died and there's funeral costs to cover. Someone needs book for school. There are hospital bills that need to be paid. And individuals want to donate just out of the goodness of their heart. This type of crowdfunding is very popular and especially helpful for social causes like the ones that I've mentioned. However, for businesses, this doesn't really seem to be a good option because, in essence, what you're saying to a possible investor or donator is that hey, if you give me money for my business, I'll go out and make a whole bunch of money with my business, and you'll just have the satisfaction of knowing that you helped me do so. And so for profit businesses, it's really not a good option, although you can try it if you'd like, of course. The second type of crowdfunding that exists is reward based crowdfunding. With reward based crowdfunding, this is where you're pre selling a product or you're giving rewards in exchange for the funds that you received. These rewards can be t shirts, they can be discounts, they can be your name on a sign, they can be a menu item named after you, but you're getting something in return for the money that an investor is providing. There is no equity involved though. So this is really a gifting kind of thing. You're paying for, as an investor, some valuable thing that you think the business might be able to offer. On average, these types of campaigns raise about $30,000 per company, and they can be successful if you have a product that can get the masses excited. We've had some examples of where they've gone viral, and some of these campaigns have raised millions of dollars, but on average, they do raise about $30,000 per company. So you just need to be mindful of that. Also, if you have a service and not a product, a reward based campaign can be difficult to run because you don't have a thing to pre sell or a product to give away in exchange for the money that you're raising. The next two types of crowdfunding are the securities based crowdfunding. We'll talk about lending first and then we'll move to equity. For lending crowdfunding, this is focused on loans. This is where you're crowdfunding a loan from individuals. Everyone might give, a smaller amount to help you get to that large loan amount of $10,000, $20,000, $50,000. On average, those investments might be $1,500 dollars each. And then you're going to, as the business owner, pay those loans back over time. The primary difference though is that you as the business owner get to decide the terms of that loan. So that may mean that you will determine the interest rate. You will determine the payback period. You will determine how often payments are made. But the power is in your hands as the business owner to determine how that loan will be paid back. The last type of crowdfunding that exists, and the focus of this class, will be regulation or equity crowdfunding. Now, based on where you're located in the country or the world, the laws differ. So, we're going to use an example of Illinois, where our office is located, just as a sample of what is possible. But regulation crowdfunding allows you to sell equity in your company in exchange for the funds that you're receiving from outside investors. You can now publicly solicit these funds from the public, who will be unaccredited investors most likely, and you can sell them little pieces of equity. On average, businesses might end up selling less than 10% of their company to raise the funds that they need for their operations, but they are selling equity. There's no doubt about it. You will be giving up or selling a portion of your company to raise the funds that you need. And primarily, these funds will be raised from non accredited investors. So remember, accredited investors are those who make over $200,000 as an individual or $300,000 as a couple, and or have a net worth of $1 million or more, not including their home. In the United States, 97% of the population does not meet that definition, meaning now you have the opportunity to sell your equity investment to 97% of the population. That doesn't mean that, of course, you'll reach the whole 97%, but now this whole new market of potential investors is open for you to sell your equity investment to. So those are the different types of crowdfunding opportunities that are available. Again, if you have any questions, you can always send us an email and we'll move forward from this point.